Equity research with Morgan Stanley joins us now. Morgan Stanley is having the big annual conference here in Mumbai, and we are exclusively trying to understand the real messaging to their clients and what they currently are indicating in terms of a theme, approach, idea, and where the future of the economy is headed. Sumeet, good morning. It's your first time, at least I'm interacting with you on this forum. So lovely to have you. I keep on reading and enjoying some of your reports. My first question is that there is perhaps a universal consensus that the banking sector in India is in some kind of an uptrend. Credit growth is strong, NPAs are low. But do you think this consensus from a stock market standpoint is baked in?
Yeah, thanks. Thanks for having me on the show. The banking sector, I think so, is on an uptrend. I agree with that. What you're going to see is some cyclical moderation in margins and credit cost. But the more important thing to look at is that the return ratios for Indian banks will still remain above normalized levels, at least for the next couple of years. The other reason why I agree with your view is the credit cycle. What we have seen more importantly over the last 2 years is normalization of credit in, say, retail segment, SME segment, to an extent the working capital requirement of corporate India. What we have still not seen is a pickup in private corporate capex cycle. You look at the balance sheet in India now, corporate debt to GDP has come down quite meaningfully over the last 15 years. They're completely delevered. Banks have seen a sharp reduction in bad loan ratio. The coverage ratio has improved quite meaningfully. The government has taken a number of initiatives such as PLI. Look at the corporate capex announcements that have happened over the last 1 year. If the stage is set for a very strong recovery in private corporate capex. It may take some time. There could be a delay of 2-3 quarters because there are elections pending. Global environment is slightly more tricky. So the implementation may take time. But this recovery in credit cycle is not going to be just 1-2 years. We think there's something which is going to continue for the next 3-4 years. And as you see credit cycle, credit growth pick up, the banking sector can continue to do very well.
What is your understanding of how many quarters more this credit cycle will last? Why I'm asking you this question is that if I only look at, let's say, State Bank of India, they've hunkered down their credit growth numbers. I spoke to the chairman of CEO of Axis Bank, Amitabh Chaudhary. He also is of the view that credit growth is slowing down. That's part one of the story. Part two of the story, interest rate cycle is nearing its ends, which means peak of the NIMs are also behind us. So are we not in some kind of a deceleration with a moderate growth rather than high growth?
So yeah, I hear where you're coming from, and that's completely right. See, over the next 2-3 quarters, you're going to see a couple of cyclical changes. So margins that has improved quite meaningfully for Indian banks, and over the next 3-4 quarters, margin will come down. But remember, even as margins come down, and if I look at the exit margins in fiscal 24, they're going to remain much higher than what we have seen in history. So am I comfortable that margins are way above normalized levels? I should be happy about that. Credit growth, yes, we have some base effect that'll come from last year. Last year, same time, the working capital demand had gone up quite meaningfully because of inflation. As inflation moderates, there'll be some deceleration in corporate credit. But I'm just trying to think that should I worry about some short-term deceleration over the next 2-3 quarters, or think about what is going to happen over the next 2-3 years as and when private corporate capex picks up? The more important thing which I want to highlight over here is the balance sheets that we are operating with. I have not seen these balance sheets for 15 years that I've been covering this sector. As you see more and more capex implementation, the credit growth is not, from a 2-3 year perspective, the credit growth will not only stay at 15%, I think so it'll go above 15% 2-3 years down the line. If I can put one more stats here, 2000 to 2010, if I look at that decade, the credit multiplier in India was 1.5 times. Last 10-12 years, the credit multiplier has been 1. If I look at corporate sector, it has been less than 1. There's no reason why the credit multiplier is not improving. We had put out a report articulating why this is India's decade. Our view is that credit to GDP, which is around 57 to 60% right now can go to 100% by the end of this decade. So I want to focus more on the medium-term story, which looks very constructive. Yes, there are some cyclical headwinds over the next 3 quarters, but that's fine.
That's the take coming in on banks so far and what the overall construct is looking like. Sumeet, just hang on with us. We're going to take a very quick commercial break, but we'll come right back and continue our chat with you.
Okay. In conversation with Sumeet Kariwala of Morgan Stanley, and we are discussing the future of what lies ahead for the entire banking sector per se. Sumeet, the general view with everyone is that big banks have the right to win. They're getting CASA, they have technology, they have management. But these are not the high growth banks. The high growth perhaps is still because of the base with mid-tier banks, the AUs and the IDFCs of the world. In such a strong credit cycle, to your mind, for a stock market investor, which offers better potential, in terms of return? I mean, for someone who says, look, I don't mind going down the ladder. I'm not that particular about cutting down the market cap size.
Sure, that's an interesting question. Actually, a tough one when the credit cycle is so good and every bank does very well. What I would want to differentiate is that the current cycle is a lot different than what we saw over the last 10 years. Over the last 10 years, a lot of large banks were going through credit cycle. They were not that aggressive with respect to deposits or lending. And you had, to an extent, edge as a mid-sized bank to grow faster. What is going to happen in the current cycle, and I'm not talking about any individual bank here, but as a group, the large private banks will be able to gain faster market share in terms of loans and also improve profitability at the same time. Scale has a very differentiated advantage in this cycle. Funding is also going to get a lot more important as more and more banks turn competitive. The large banks as a group, they've invested in technology, and the kind of operating leverage that they can drive over the next 4-5 years is going to be quite meaningful. Think about some of the revenue headwinds that are going to come in terms of, say, competitive intensity, regulatory changes, etc. These banks, because they're sitting on a lot of operating leverage, they can better drive core PPOP growth and margin. So as a group, we think large private banks will do better than the small banks. There would be individual small banks, or there would be some large banks which may not do that well. But as a group, we think that this decade is for the large private banks.
The overall general view within the investment fraternity is that it's the corporate-facing banks which would win over the retail-facing. But if the view is bullish across the banking pack, then why this differentiation? And do you believe that the corporate-facing banks would continue to win over the retail guys?
So I honestly don't differentiate between corporate and retail in the current cycle. This was something that we used to do for the last 10 years because the corporate banks were going through a very tough NPL cycle, and to that extent, they were not able to gain market share or deliver on asset quality. The current cycle is going to be good on corporate and retail. And if I look at banks, they have a fair mix of both corporate and retail loans, and to an extent, the growth outlook is interlinked. If you're seeing a lot of corporate capex, there'll be significant benefit that'll happen to the SMEs, to the supply chain. There'll be more hiring, there'll be better income growth. So I think you will see growth across the ecosystem. The way in which I would want to differentiate is that who has a better funding franchise, because they'll be able to gain faster and more profitable market share. Who has invested in tech over the last 3 years, and who can increase the share of digital loan originations, who can drive higher cross-sell, who can have resilient processes as the bandwidth issues come to the fore. The large private banks as a group are better placed, and which is why we have a preference over there. Not trying to distinguish really between corporate and retail banks in the current cycle so far.
I want to pick up a point from your answer. You said that forget about next 2-3 quarters, you expect credit growth to go beyond 15%. And that if it happens after 2 years or 1.5 years, that means you're expecting credit growth to pick up on a very large base. What gives you the confidence that the credit growth could be 15% plus, given that we have an election cycle in between?
Yeah, see, think about it this way. If you look at over the last 10, 12 years, when as a country we have gone through multiple crises, that could be because of the corporate NPLs that came through after 2013-14, number of regulatory changes, the NBFC challenges that we faced, COVID, etc. During this period, you had a overall credit growth of 10% with retail and SME growing more than 15% plus. Think about what is going to happen over the next 4-5 years. Retail and SME continues to remain underpenetrated. There's a lot more data available on consumer and SMEs, which is why credit availability is going to increase. These two segments, can they grow at 16-17%? I think so, it's possible. What has lagged over the last 10-12 years is corporate banking, corporate lending. Corporate lending, which has been growing at 5 to 7%, can accelerate to 14-15%. I don't think so. That's a tough ask. Let the private corporate capex cycle come through, and you would see corporate sector growing in line with retail and SME. And it's pure summation. If I think corporate capex cycle comes back, overall credit growth can be running at 15-16%. And this is not something which is very tough. You're talking about a high base, but credit penetration in India is still quite low. And we have seen this when you have had corporate segment do well along with retail and SME. We have seen credit growth of 15-16% in the past. I don't think so that's a very tough number. Yes, the key ingredient is private corporate capex, and as that comes through over the next 2 years, one should not be that surprised.
One of your mails, one of your reports, 10th of May, it has your name, it's been authored by your team, the ECL guidelines. There's a lot of confusion on what would be the impact of ECL guidelines, at least on PSU banks. And Morgan Stanley, what is your house view?
Yeah, so I think so the numbers that have been given by some of the state-owned banks with respect to ECL doesn't pertain only to ECL implementation, but a number of other changes that might happen as part of IFRS, and the banks have clarified that. Our assessment of potential ECL requirement at state-owned banks would be around 1 to 2% of loans, 1% for the stronger banks, 2% for the less stronger banks within our coverage. What also needs to be understood is that the provisioning coverage ratio at Indian banks have improved quite meaningfully over the last 2-3 years. If I would have done a similar exercise, say 2-3 years back, the number would have been very different. And the credit cycle is going to remain benign over the next 2 years. So as these banks continue to build up coverage ratios, the numbers can come down further. But based on the current numbers, our assessment will be that it's 1 to 2% of loan book.
Right. Okay, Sumeet, great to have you on the show today. Thanks so much for taking the time out, and have a great conference.